Okay, good morning. It is 10 a.m. on Tuesday, August 9th. So that means it's time for our Tuesday morning weekly webinar. Hope everyone's doing well. We're counting down our summer months. It goes so fast, doesn't it? I've been down to the beach, I guess 3 times, but not for long. So I appreciate and I'm a little jealous of all you folks that are spending so much time at the beach and away. I'm hoping I get to do that myself before the end of the summer. That said, next week is a vacation week for me, so there will be no webinar next week. I'm going to write myself a note to send out a cancellation notice. I don't like to do that prior, too early, because then people are confused and they think that the upcoming webinar is canceled. So I like to make sure that I do it after our Tuesday webinar. I hope that makes sense to you. But next week I am taking some time off, so next week's webinar is not going to happen. Okay. Well, I hope everyone's doing well. Just raise your hand for me if you can see me and hear me okay. To hit the raise hand button. Thank you, everyone. Just want to remind you, of course, that you are being recorded. And if you're watching this on YouTube, so we get some people watching on YouTube now, not just live, but we find a lot of folks catching up on YouTube. And we started to split the, all of our videos are indexed. So if you went onto YouTube, you could scroll through or even in the comment section or the information section, it shows, at what time to go to this section, the slot reports, the investment discussion, and the financial planning topic. But because these webinars go about 45 minutes or so, sometimes a little longer, we've also separated the financial planning topic. So if you wanted to, just like today, we're going to talk about taxation of Social Security. So this is something that has come up in conversations with prospective clients and clients recently, and that always triggers a discussion with you folks. As a reminder, many of you have heard about taxation of Social Security before. Many of you could probably tell me all about it, but these keeping things top of mind and reminders are important, because again, we're trying to overcome about 40 years of misunderstanding, misinformation, sometimes just being down the wrong path. So we want to bring these things not only to your attention, but we really want to just keep them as part of the regular discussion, so that it's always there for you. So we've started to split the videos. We have not really split it, but we have a standalone video on YouTube and on our website that'll be the entire weekly webinar. And then there's a section that's carved out for this last 15 or 20 minutes of the financial planning topic. So we hope that's helpful. As always, let us know your thoughts. But if you're watching this on YouTube, hit the click and subscribe. We're starting to see people do that, so that you never click the like and subscribe, and there's a bell you get and a notification you get when there's a new video. So that's good. So we're going to go through about 15 minutes of slot updates. There was a lot of good material today, and I had to actually leave a section out that I hope I remember to come back to in 2 weeks when I see you again. But I didn't want to spend too much time. It probably would have taken about a half an hour of our time. But good material this week from the Slott group. We're going to talk about market updates and analyst reports, and then we're going to talk about our financial planning topic, which I already told you is taxation of Social Security. That's a really, there's a lot of information there. It's a bit of a complex topic, so I'm going to try to leave a good amount of time for that. And of course, you're muted. There's a Q&A at the bottom of your screen section, so you can click on that Q&A window, type questions as you go, and I'll address them to the best of my ability. And you are recorded, of course. So just a reminder, we do have a special webinar coming up in August, the end of August, August 24th. So 2 weeks from tomorrow, with Alicia Barnett, who is, really the long-term care specialist that I go to for solving long-term care planning issues. So Alicia helps us a lot. Alicia and her team helps us a lot with tools and resources. So you'll get an invitation for that webinar in the next day or so, hopefully by tomorrow, but it might be Thursday. And then we will have a date. We're really running up against some scheduling issues with the advanced class, so I hope to have that resolved. I really wanted to have it done in August, but I don't think that's likely. But that will be likely be an on-demand webinar, so it'll have a look and feel like you're in a live webinar, which is kind of neat. But you'll be able to schedule it really at a convenient time for you. Still be able to chat and email, and those emails will come right to us, or the chats, and we'll be able to answer questions, and we'll see how it is. Again, tell me how it works for you. All right, so headlines, everybody's paying attention to what's going to happen with the consumer price index tomorrow at 8:30 a.m. So the expectations are that inflation is not going to move much. Hopefully it doesn't increase, but everybody's kind of holding their breath on that one. As I'm reading through headlines, every day, there's a lot of back and forth about, are we in a recession? Yes or no? What does that mean? Different people say yes, different people say no. We talked about it in our last webinar last week. What's the definition of a recession? My feeling is that we've been in a recession since really the COVID drop at the end, or excuse me, the middle of 2020. So I think looking back, certainly in 2022, they're going to say yes, recession. But I think if we're being honest, we've been in a recessionary environment really since March or May of 2020. So still, I've got a headline here: Russia and Ukraine. Still lots of uncertainty. It's just still an ongoing mess over there. Let's talk about our Slott updates for today. So I'm going to share my screen. Give me a moment here. So again, for you new folks, because we do have some new folks who have joined us, if you see me looking around, I'm working on, like many of us do, I'm working off of 3 different monitors, moving things around. So, if I'm not watching the TV, there's a TV over there too, but I'm not watching the TV or talking to somebody else. I'm just trying to get things together for you. So hopefully now you see in front of you what says Slott updates. Just hit your raise hand button if that's what you see. Thank you, Carol. Thank you, Don. Good to see everybody. And this first one that we see is from Andy Ives. So you've met Andy. I can't wait to have one of the analysts back. So we've had Andy on, Ian, I guess we had on too, and Sarah. We may not. I'd have to go back and see. But there has been so much since I guess we had Sarah on last, and that was probably March. There's just been so much happening since then. Of course, the Inflation Reduction Act passed the Senate last week. So no matter how you feel about this, there's some directions towards climate change and a lot of spending in this bill. But this is not a political statement, but you talk about a bad headline. The Inflation Reduction Act. I don't know if there's anything in there from what I've read that is going to reduce inflation or work towards reducing inflation, but they're good marketers down in Washington, that's for sure. So I forget my point, but I want to have Andy, one of the analysts back, because there's just so much, and that's one of the things. Now, we could talk about the Inflation Reduction Act, but until it's really law, it's likely that it'll pass through the House of Representatives on Friday, and then President Biden already said he'll sign it. So it's likely it's a done deal, but you just don't know. The senator from Arizona required $4 billion of earmarks to her state to get on board. Her name's escaping me right now. So you just don't know what a legislator is going to add on to there. All right, so this first question here is: my husband is the sole beneficiary of a traditional IRA owned by his cousin. Now, this gets a little complex, but it's really interesting regarding the stretch IRAs and eligible designated beneficiaries. So pay close attention to this, but it does get a little confusing though. So I'll start from the beginning again. My husband is the sole beneficiary of a traditional IRA owned by his cousin who recently passed away. So then she writes, from my research, I believe my husband fits the exception criteria of an eligible designated beneficiary, in that he is not more than 10 years younger than the deceased. He is 9 years younger. He is age 72. So husband's 72. Deceased was age 81. So that tells us a couple things. The deceased was already taking required minimum distributions. As such, from what I read, he does not have to empty the inherited IRA account within 10 years and can withdraw his RMDs using the stretch IRA method. So that's one occasion. If you're an eligible designated beneficiary, you can continue that stretch IRA function. But you have to fit the criteria. Can you please confirm this? I know that for the year of his cousin's death, 2022, he needs to take whatever RMD she still needed to take. But after that, it looks like he can stretch his RMDs and does not have to empty the account within 10 years. So does that sound right to you? Let's see what the answer is. So Andy writes, Chris, excellent detective work. You are correct on all points. Since your husband is not more than 10 years younger than the original account owner, his cousin, then he qualifies as an eligible designated beneficiary and can stretch required minimum distributions over his single life expectancy. Since the cousin died this year, the RMDs for your husband will begin in 2023 using his own age next year and the applicable factor from the IRS single life expectancy table. Now, again, you can access that table on our website, attleborowealth.com, under the slot corner. Scroll all the way down. I think that's the bottom table, and you can download that or just use it on the website for yourself. You are also correct that your husband is responsible for taking his cousin's year of death RMD. That needs to be withdrawn before the end of the year. So really great work. It seems like from a lay person who just did her research and really nailed it, because these RMD rules have always been a bit confusing, and now they're even more confusing. So nice job. All right, so this one's from Ian, and this just came out yesterday, and this one's a little lengthy, but I think it's important. The unpleasant surprise of the accuracy related penalty. So Ian begins with if a retirement account transaction becomes a taxable distribution, you probably know you will owe taxes and possibly a 10% early distribution penalty if you're under age 59 and a half on the distribution. But what you may not know, so everybody knows that, right? You take money out of the IRA. Hopefully, you know that you're going to pay tax on that, unless it's pre-tax money and you've been keeping, or excuse me, post-tax money, after-tax money, and you've been keeping records of it. So everybody knows that you got to pay tax on that money. But what you may not know is there might be an unexpected surprise. On top of the additional taxes and 10% penalty, you might also be liable for what's called the accuracy-related penalty. Here's what you need to know about this unpleasant revelation. Let me scroll up for you. Okay, the penalty normally kicks in if you substantially underpay your federal income taxes. And underpayment is substantial if it is more than the greater of $5,000 or 10% of the tax that was required to be shown on your tax return. You could also owe the accuracy-related penalty if, in preparing your tax return, you acted negligently or disregarded IRS rules or regulations. The accuracy-related penalty is normally 20% of the underpayment, so that can be significant. The IRS will waive the penalty if you can show that there's reasonable cause for the underpayment and that you acted in good faith. The IRS considers reasonable cause on a case-by-case basis, taking into account all pertinent facts and circumstances. That sounds expensive and complicated to me. However, the IRS says the most important reasonable cause factor is how much of an effort you made to determine your tax liability. And this is one of the things I really enjoy in our slot updates. So I'll be in Las Vegas with Ed and his team in October. And I love reviewing these court cases, these tax court cases. So a recent tax court case, La Rochelle et al., and others, versus Commissioner, the tax commissioner, illustrates the accuracy related penalty and the reasonable cause exception. In 2017, now look at that. This gets resolved in 2022. So that's, I don't know when this started in 2017, but it's, you're looking at about 4.5, maybe 5 years. In 2017, La Rochelle withdrew $238,000 from his IRA, but he and his wife did not show the distribution on their tax return. Since the couple had moved in 2016, Mr. La Rochelle claimed he never received a 1099-R from the IRA custodian. So the IRA custodian, if it's Charles Schwab or the Vanguard or Fidelity, they issue these 1099-Rs. These are electronically also sent to the IRS, so there's no hoping that they're going to avoid that, especially for a large amount like $238,000. The IRS picked up on this failure to report $238,000 and assessed additional taxes and accuracy-related penalties. The La Rochelle's paid the taxes, but asked the IRS to waive the penalty. After the IRS refused, the case went to tax court. Again, sounds complex and expensive. The couple argued that there was reasonable cause for the underpayment because they didn't receive the 1099-R, but the tax court said that failing to receive a tax form reporting a distribution isn't a good excuse if the taxpayer knew about the distribution anyway. So they took the money out, they knew about it, and they just didn't report it. That was the case here. Next to La Rochelle's claim that they had relied on their tax preparer to produce an accurate tax return. But the court didn't buy that one either. The court reasoned that since the couple hadn't informed the tax preparer about the IRA withdrawal, they could not have expected him to file an accurate return. The $9,075 penalty stood. I'm certain they paid more than $9,075 for an attorney all this time. The filing fees, everything else, I'm sure it's much more than that. The threat of the accuracy-related penalty makes it even more important to know about and accurately report all taxable retirement account transactions. So that's pretty outrageous, right? Taking $238,000 out of the IRA, I guess spending that money and then just never reporting it to the IRS. Who in the world would do that? Well, that is pretty negligent, I would say. If I was on the tax court, I'd probably think the same way without knowing the rest of the facts. But this is where people get caught up sometimes on the accuracy related penalties. They'll say, I'm going to do a Roth conversion and I'm going to do it in March, or I'm going to do it in June. But in my head, I'm thinking, I don't have to pay that. People ask me this all the time. When do I have to pay that tax? And because they think they have to pay it, when they reconcile their taxes at the end of the year, and their taxes are due, the filings and taxes are due April 15th or whatever it falls on in that tax year. But that's not the case. You could be subject to penalties if you do especially if you did a $200,000, $238,000 Roth conversion in June and didn't pay your tax on that until the following year, April 15th. You may certainly be subject to an accuracy related penalty. And again, 20% of what you should have paid in. So it's always best practice, and you want to review this with your tax preparer. So first of all, have your team together. So qualified certified financial planner who specializes in tax efficient planning, a CPA. I'm certain there are very good enrolled agents out there and other people who do taxes who aren't CPAs, but if you have significant assets, if you want to be serious about your financial planning, hire a CPA, and make sure he or she has all the facts. And a good CPA, by the way, is going to make sure they have the facts. You're probably going to want to make quarterly estimates, or just pay the tax in the quarter following the time that you do the Roth conversion. So I hope that makes sense. If you do a Roth conversion in June, you're going to have to pay tax in that following quarter. It depends on really when you do it, but you don't want that whole tax year to go by, in my opinion. Okay, so I see a question. Let me stop my share and I'll see if I can answer this question. Yes, Walter, it's Cinema or Cinema, the senator in Arizona. Thank you, Walter. Walter's always quick on the draw with the answers. I appreciate that. All right, let's talk about the market. So we're getting our market update from Franklin Templeton this year, and they've been writing some good analytical reports as well lately. And their discussion this week was higher inflation, recession more likely, in the Franklin Templeton Institute's mid-year perspectives. There's a discussion whether stagflation, which is inflation plus slowing growth, scenario can be avoided, and where investors might find opportunity or at least temporary shelter. So we can't, that's an interesting concept. We're sitting on a lot of cash. We've talked about this for over several months now. We can't maintain that because people need some return. When inflation's at, nearly 10% and your cash is earning next to nothing, it's like losing 10% a year. So you can't have that. You've got to have some growth potential in there. But last week the S&P 500 was up 0.39%. The Dow Jones was down 0.11. So that's basically flat. They didn't move much. NASDAQ was up about 2.18%. The Russell 2000, which is representing small company stocks, publicly traded small company stocks, is at 1.96% up. What they're classifying as foreign stocks was down 0.65, and emerging markets was up slightly, 0.97. Year-to-date numbers are still terrible. The S&P 500 is 12.2% down. The Dow Jones is down 8.7. The NASDAQ is still down 18.7. The Russell 2000 is down 13.8, negative 15.8, negative 16.8, all red across the board for the major indices, including bonds, right? The bond indices are down anywhere from 10 to 14%. So if you think you're safe going to bonds, you're having a hard time there. Some of them are down 3 to 4%, which isn't bad, but can't maintain that either. Interestingly enough, we know energy's up 34.8%. Utilities are up 5.4%. So it's such a weird economic situation right now. I'm in the process of trying to find a car for my 16-year-old daughter who gets her license in December, and we really want a plug-in hybrid. I would prefer to have a full electric car, but going away to college, she has some anxiety about where she's going to charge this thing up, and I can appreciate that. So we're trying to find a plug-in hybrid. Oh my goodness, what a challenge it is to buy a stinking car. Really just weird times. Okay, let's talk about really the only analyst report other than Franklin Templeton I want to discuss is BlackRock, because BlackRock's taken a bit of a turn here. So they're still focusing on credit, so bonds over stocks. So it wasn't that long ago they were talking the other way, still in favor of the stock market over bonds, but I guess it's been about a month now they've turned that corner. But they write, we prefer investment grade credit over equities. So credit equals bonds, equities equals stock. Our reasonings: valuation, strong balance sheets, low supply, and moderate refinancing risks. So that's all the reasons they're given for, okay, now they're shifting to investment grade bonds over stocks. So they're not that they're jettisoning stocks altogether, but they're a tactical manager. So they're going to make changes in their allocations accordingly. U.S. data last week showed strong job creation, but still low labor participation. Stocks lost steam and bond yields spiked as markets priced in more Fed hikes. We expect U.S. CPI and PPI this week. Everybody knows what CPI is, right? Consumer Price Index, what we pay for things. PPI is Producer Price Index, what it costs really to make things. We expect U.S. CPI and PPI data this week to show that high inflation is persisting. China's social financing and CPI inflation data are also in focus. So BlackRock is now saying they're preferring bonds over stocks from an overweight point of view. All right, now let's see. We have a question. All right, so Walters is talking more about this. The tipping point for Cinema to sign on was the reinstatement of the carry forward interest loophole. It was eliminated as part of the original bill, payoff to our hedge fund contributors. Well, it's interesting because the interest carry forward is really an interesting topic, because it has to do with investment returns for certain types of investments, and it's taxed at capital gains, and people think that it should be taxed differently, and that was set aside in my reading in the proposed bill. Is that and I'd have to go back and see how it was replaced. I think it was replaced with a flat corporate tax rate that is expected to bring in a much greater amount of revenue. So from a revenue, I'm always torn in these situations, because our country needs to bring in more revenue, and more revenue is higher taxes. So we might start at corporate tax rates. We might start at raising the cost of Medicare, like we saw last year. We may start all around the fringes here that don't affect us directly. It'll affect us indirectly. If you think about it, in a higher inflation environment we're in right now, it's probably not a great idea to have tax increases at all from an economic point of view. But it's not, it's not likely to help our economy. But we have to start doing something to shore up the health of our country, and it should be financial health of our country, and it should be raise taxes and cut expenses. And the government is not going to cut expenses unless they're absolutely forced to. And I don't know what that forcing will be, because nothing has really driven that on a large scale, at least in some time. So, this is, I'd like to say this is the start of it, but the start of increased taxes really happened, during the Secure Act when that came out, forcing taxation of IRA accounts prior. There were some other items in that bill as well that really started the increase in revenue, which simply means more taxes. But it's all, the middle class pays most of the tax, so that's has to be where the focus is. Again, not a political discussion at all, just factual. All right, now let's get into the financial planning topic. So I'm going to share my screen again. And I'm going to say again, because some folks just joined this portion on the YouTube video. So if you want to follow these videos, get notification when there's new videos, hit the subscribe button and the like button, and you'll be notified when they come out. So today we're talking about taxation of Social Security. So this is another embedded future tax increase for most people collecting Social Security, or many people collecting Social Security. So some people, just still don't know that your Social Security can be subject to tax, which is amazing to me. But if you're not planning and you are just going into retirement, maybe you're 50 some years old and this is just not on your radar. I'm sorry, I'm pulling up my tax chart here. Then you're not aware of it yet. Just like the out-of-pocket costs of Medicare. It depends on where you live in the country. Your average healthy person pays about $5,000 to $6,000 a year in out-of-pocket costs after they begin receiving Medicare benefits. And so for a couple, that's anywhere from $11,000 to $12,000 a year or more. That's for a healthy individual. Most people who aren't close to Medicare age or aren't already collecting those benefits or receiving those benefits, that's not on their radar either. And so a lot of people are surprised when they hear that their Social Security can be taxed. All right, I need to pull up give me 1 second. Okay. I just need to pull up my tax chart for you. All righty. So let's talk about provisional income. So what is provisional income? So provisional income is a separate, it's not income that is derived from, people ask, well, is it modified adjusted gross income or adjusted gross income or, anything like that? No, it's its own calculation, provisional income. Provisional income is the income that the IRS tracks to determine how much of your Social Security is taxed. So it's an entirely separate things. It's not capital gains. Again, it's not Maggie. It's not AGI. It's none of that. It's its own calculation. So let's talk about what counts as provisional income. So again, the direct connection to your Social Security, anything that you earn. So any earned income, any W-2 income, any 1099 income, anything that you earn counts as provisional income. Well, that makes sense. Any distribution from your traditional retirement accounts, your 401ks, your IRAs, your 403bs, anything that is a traditional promise to pay the tax later retirement account. And yes, that includes RMDs. So RMDs, even though you're required to take those distributions, the IRS says you must take these distributions, but you have to pay tax on them, and it counts as provisional income. Any 1099s from that taxable bucket. So, remember your buckets. You have your taxable bucket, your tax deferred bucket, and your tax-free bucket, or tax advantage, whatever you want to call that last bucket. So any dividends that you get in that taxable bucket, you get a 1099 for. Any long-term capital gains, you get a 1099 for. Any short-term capital gains, you get a 1099 for. Any 1099s you get out of that taxable bucket, or K1s for that matter, you get out of that taxable bucket count as provisional income. And those short-term gains and long-term gains, sometimes you can't control because they're in mutual funds. Many investments are in mutual funds, and those funds have internal gains and losses all year round because they're selling and buying things. And you can't control that. You get your capital gains statement at the end of the year. And sometimes, you can have a down year in your fund and still get a large capital gain. So 1099s from the taxable bucket. Any pension income you receive. So if you have a pension, that's great. Any income you receive counts as provisional income. Any rental income, if you have rental properties, any rental income counts as provisional income. Interest from tax-free municipal bonds, that gets added in. So if you have, some people invest in municipal bonds with the idea of, hey, well, if I put enough money into tax-free municipal bonds, I can get thousands, sometimes hundreds of thousands of dollars a year in interest that I won't pay tax on. Well, the only problem with that is it causes your Social Security to be taxed because the provisional income calculation grabs interest from tax-free municipal bonds. And if all that isn't bad enough, they then add in 1/2 of your Social Security. So all earned income, distributions from your IRAs, retirement plans, of course, required minimum distributions, 1099s from the taxable bucket, pensions, rental income, interest from tax-free municipal bonds, and 1/2 of your Social Security. So how do we then calculate? We take all of that. Now, how do we calculate then how much of that provisional income equals taxation of your Social Security? Well, let's add these up. So I have the tables here. So let's first look at a married couple. And you have to remember that whether you're talking about the marginal tax rates or you're talking about things like provisional income, as soon as you're single, things get harder for you from a tax point of view, because you might have less Social Security because you lose your spouse's Social Security, or you lose yours and you pick up your spouse's, but you're likely to have the same amount of other income because most arrangements are my spouse inherits my funds when I'm no longer here. So your tax rate jumps up because your tax margins decrease, right? Your income margins restrict because you're single filer, and that's the same with provisional income. So let's just focus on the married provisional income for right now. I see a question. I'll get to that in a second. So if all those things I just talked about, earned income, distributions from your retirement accounts, RMDs, 1099s from your taxable bucket, pensions, rental income, interest from municipal bonds, and 1/2 of your Social Security, if all of that is under $32,000, then none of your Social Security is subject to tax, zero. Anywhere from $32,000 to $44,000 up to 50% of your Social Security is subject to tax. It's a formula you have to complete to see how much of that money is subject to tax, but it's up to 50%. And then anything above $44,000, well, up to 85% of your Social Security is subject to tax. So you can see that with all those categories, including 1/2 of your Social Security, you can get above $44,000 from a married couple pretty easily. Now, for a single filer, of course, it's worse. So for single folks under $25,000, no tax on your Social Security. From $25,000 to $34,000, up to 50%, and above $34,000, up to 85%. So there are the tables. Now we're going to talk about the inflation of these tables, or lack of inflation of these tables, in a few moments. But that's, so we funnel all that information and we say, okay, where do we land? If you're above $44,000, as we are in the example I'm going to share with you, then you have to apply tax to 85% of your Social Security. So what does that look like? Let's talk about the tax applied. So stay with me here. I'm going to draw this out for you. I'm going to be looking down so I can draw this. So I went into a plan that we were just working on because I wanted to use actual numbers. Let me just see what the comment or question is before I move on. So Gerard asks, George, steal my thunder a little bit, but how are IRA to Roth conversions treated oh, I see, that makes sense. How are IRA to Roth conversions treated regarding provisional income? Well, it's a IRA to Roth IRA conversion is actually a distribution that's allowed to go into a Roth IRA. So it's considered a distribution. It's going to count as provisional income. Good question. So it's not uncommon for, if you're collecting Social Security and doing Roth conversions at the same time, it's not uncommon for your Social Security to be taxed at a higher level during that time. So of course, what you have to balance, you have to do the math, just like you do with your IRMA calculations. We're going to talk about IRMA in a few weeks, but you've got to make sure it's worth it. So the question is it worth it for me to pay tax on my Social Security for a period of time and maybe avoid that tax for the rest of my life, or lessen it to do these Roth conversions? But let's look at, and that has to be part of the planning process, and to determine how much Roth conversions you want to do. And again, this is why you should work with somebody who understands the nuances of this. So I pulled this information from an existing plan. So the one spouse's Social Security is $40,248. The others is $37,644. So obviously they fall under this married couple, and they're all together. Their provisional income is over $44,000. You'll see here again how easily it reaches. So the math on that, those two Social Security amounts to $77,892 divided by 2. So there's $38,000. So if we divide that by 2, that's $38,946. So it doesn't take much to get over that 44,000. So if we're not, and this couple actually has a pension and whatnot, so they're over to 44,000. So now we determine that this couple is subject to taxation. And now how much of that? So then we have to take, and again, just to keep it simple, we're going to do the full 85%. So we take 85% of the 77,892. It's not taxed at 85%. People often confuse. I've even heard people teaching this who say taxed at 85%. That's not true. It's 85% of your Social Security is then subject to tax. So then 85% of 77,892 is 66,208. I'm rounding up in this case. And let's assume they're in the 20% tax bracket. So this money here now has to go into that, marginal tax rates, right? That range from 10 to 37%. And then this 66,208 goes into here. And then we determine where it lands and what's the taxable rate. So at this, let's assume a 20% effective tax rate. There's other income in there, and the Social Security either lands right on top of that, or is mixed in with it, however you want to look at it. But they end up with a 20% effective tax rate. So 20% on 66,208 is $13,241. So that's the tax that they have to pay on that Social Security. So there's a couple of things that are frustrating about that. First of all, you receive this money and then you got to give back $13,000. But the other thing is, most people think of Social Security this way. Well, we're going to get $77,000 a year. They're counting on $6,941 a month, right? So they're saying, well, we need to live in retirement. We want to do this, this, and this. And we're counting on just call it $7,000 a month to live off of. I got that backwards. $6,491 a month. So we're counting on $6,500 a month to live off of. Well, not really, because what they may not have realized is that they have to pay the IRS this $13,241, or how much is that a month? I think it was, where did I go with that? We'll do the math real quick. Yeah, 1103. Yeah, so that's the difference for them. That's now 1103. And again, I'm rounding down on that one. That they're losing every month in their income just because of this tax. So it's not 6,941 that they get to live off of. It's $5,387. Again, rounding down. So that can be a big difference. You know, that's about obviously $1,100 a month that they're giving up. You know, that could be a vacation, that could be a car payment, that could just be, you know, who knows, anything. So now what do people do to make up that $1,100 a month, or, you know, $13,000 a year, however you want to look at it? Well, most people say, okay, well, I was planning on $77,000 a year or $6,500 a month. Now I need to make up that difference. And they say, okay, I'm going to take that out of my investments. And where do most people take it from? They take it from their IRA. So they say, all right, well, listen, I need to take another $1,100 a month out of my IRA. But if you take $1,100 a month or $13,241 a year out of your IRA, what do you have to do? We have to pay tax on that distribution too. So we have to what's called gross up that distribution. So to net out, using a 20% tax rate, to net out $13,241 a year, which means what does net out mean? That means that's the amount that you get to spend. Well, you have to take out $16,551. $16,551 is what you have to take out, pay tax on, and then you get to spend $13,241. So it's a compounding problem. It's not just that you're giving up $13,000. It's likely that you're giving up $16,551, and you got to send that portion of, you know, the $3,300 and change to the IRS for additional tax. And now you're drawing out of your IRA. Maybe you weren't planning on drawing down on that IRA at that time. So if you're not planning for this and you hit it by surprise, boy, it can be really a detriment to a financial plan. And suddenly, if you just you're rolling into retirement and you've got these plans for vacation. And listen, folks, $13,000 a year, most people allocate $10,000, $15,000 a year for a vacation. So that could just wipe that right out. So it's important to know what your taxation of Social Security is going to do to your plan. Now it's not, you know, obviously the answer, the issue isn't just the $16,551, because there's a couple of things that happen here. So we're talking about, we talked about taxes applied. We talked about the provisional income, the definition, and the charts. We talked about filling the gap. Remember, you got to take $16,551 to cover the $13,241 that you need to spend, because you have to pay tax on that difference, right? Taxes got to come out of there. How about the opportunity cost? Well, now, if you're doing this every year, let's just say, you know, you earn 6% on that 16,551. Well, folks, that's hundreds of thousands of dollars over your lifetime. If you do the math, 16,551 by just 6%, say over 30 to 35 years, geez, folks, you're easily talking about $400,000 or $500,000 in lost opportunity cost there, because when you have to take this money out to spend, you don't get this. You don't get that return. Never to be seen again. If it's in there, it's invested. Even the market drops, it's likely the market will come back. You have an opportunity to gain the return back. But once you spend it and send the tax to the IRS, you never get a benefit on that. So hundreds of thousands of dollars if you have to take out that additional amount. And it's worse. Every year, Social Security goes up, right? Typically we get a modest increase. This year, they're talking about 10+%, because it's an inflation factor. It's not directly tied to CPI, but CPI, Consumer Price Index, is part of the formula and calculation. So as the 77,000 grows because of inflation increases, more and more of your Social Security is going to be subject to tax, because this part hasn't changed in years, and it's not likely to. these haven't increased. Your marginal tax rates, they adjust every year, not the rates, but the income levels for the rates. We're gonna see an overhaul of the tax code, I'm sure, but this, I don't see a change in this. It's never really talked about. So it's likely for the next 10, 20 years, whatever, certainly probably the next 10, these rates here for provisional income are going to be exactly the same. And just think about it. If suddenly, because of inflation, 77,000 becomes, 88,000, and Social Security, and one half of your Social Security is tied to provisional income, well, you're at 44,000 right there. So you can see how it can really get out of control. So you've got to fill in the gap. You got the opportunity cost. You lose the opportunity to make money on that money that you're taking out of your retirement accounts or even other investment accounts to pay for your standard of living that you've given up because of the taxation of Social Security. And then we've spent a lot of time on timing. The timing of Social Security is something that people think about when they say, well, when should I take my Social Security? And there's books written about it and calculators out there and a lot of great data, but unfortunately not enough people are talking about the taxation and the effect. If you're unfortunately in a situation where you kind of have enough money for the rest of your life, you feel like you probably do, this could cause a drawdown 7 years, or actually, 7 to 9 years sooner than not having your Social Security taxed. So there can be a big effect for folks. They could be running out of money earlier. It's less money you can pass the heirs if that's a goal of yours, or just funds to have available if you need care or something in the future. So this is very important. Again, a lot of people focus on this timing. When should I collect Social Security? And that's important too. But this taxation of Social Security is just as important. Other considerations are, if you're doing, Gerard talked about, well, I was talking about Roth conversions. I guess somebody else talked about Roth conversions too. If you're doing Roth conversions and you start collecting your Social Security, it's going to affect your provisional income. You've got to set up, you got to see if there's a benefit to that. You have to do the math to see if it makes sense to do those Roth conversions while you're collecting Social Security. Some people like the idea of waiting until, they're done their Roth conversions, they're age 70, whatever their age is for them, and then collecting Social Security. Nobody really goes beyond 70, but it may make sense for you to wait. You could get more out of the Social Security Administration, and you're not paying tax on that Social Security while you're doing Roth conversions. However, some people feel that, well, wait a minute, if I'm doing Roth conversions and I'm collecting Social Security now, even though I have to send some back to the IRS, I'd rather use that amount of Social Security that I get after tax to help pay my tax on the Roth conversions. So some people like that cash flow to help pay that tax. And that's fine too, as long as it works out for you. So it is specific to you, of course, how you manage these taxation issues with your Social Security. It makes sense for you, whether you just let it run and it is going to be what it's going to be, or you look for strategies to avoid the tax or reduce the tax on Social Security. So we heard about the provisional income. There are two things that do not cause tax on Social Security, and you'll not be surprised. Anything Roth, so distributions from Roth IRAs that are held more than 5 years, do not cause taxation of Social Security because there's zero tax. So anything Roth, your Roth IRAs, your Roth 401ks, no tax on Social Security, and some properly structured cash value of life insurance or life insurance retirement plans. There's no tax if they're structured correct. If you take money out of there for your retirement income, which many, many people do, they also don't contribute to taxation of Social Security. So it's something you have to pay attention to. It's something that should be part of your plan, but that's how it works, folks. I think we've covered all the items with taxation of Social Security. We've got a lot on the agenda for the next few weeks. We're going to go through some different financial planning topics, like I talked about income related monthly adjustment amounts. That's another big consideration for Roth conversions. So Gerard asked a good question. Should the standard deduction be factored in here? No, doesn't apply. Standard deduction doesn't apply. It's provisional income is the list of items I talked about. It's not modified adjusted gross income. It's not adjusted gross income. Standard deduction doesn't apply. It's its own calculation, just like capital gains tax is its own calculation. Good question, though. All right, folks, it is 10:51. I hope this was helpful. Again, if you want to subscribe, hit the subscribe button. If you want to schedule time with me, you can do that. There's some limited time on the calendar. It's been really busy for us. Knock on wood. Thank you. We appreciate all your support. We've had, several new clients this year. We have a bit of a waiting list. New clients are onboarding in September now, might even have to go to October, but we appreciate all the support. If you're a client and you need an appointment, reach out to us. Even if you can't find something on the calendar, we'll make time for you. We are back in the office 2 days a week for appointments. Otherwise, we're doing Zoom meetings, which are just so darn efficient, but I love seeing you all in person. So we'll see you not next week, but the following week. Hope you enjoy the rest of your week. Take care.